Okay, welcome to FX Street webinar series. My name is Steve Patterson. I'm going to have to apologize to everybody right off the bat because I have a bit of a cold this morning, a little bit sick, so I'm going to have to do my best here to struggle through this. So if I'm a bit slow today, please forgive me. Little bit of information. I see some new faces in the room. Let me just get the disclaimer out of the way. Oh, there we go. Yada yada yada. Big risk. Don't listen to me. Do your own thing. Hypothetical or simulated performance limitations. We all know the drill here. All right. Okay, a little bit about me for those of you who don't know. My name is Steve Patterson, as I said. 27 years of experience in the financial markets, currently an individual retail trader, and I also run managed accounts. Trade my own account for well over 10 years right now, blah, blah, blah. For those of you that don't know how I do things a little bit differently than some of the other presenters. I form my webinars based around a lecture series. So I believe that the most valuable thing for you guys is to learn the same way you would learn if you went to a university or if you went to some type of technical college, and that is through lecturing. And then everything kind of builds on itself. So if you haven't watched any of my other presentations, I highly recommend that you do that. My style of trading is discretionary. Really kind of hard for me to say what I do other than turn on the charts every morning, figure out the pieces of the puzzle, and then exploit that puzzle. That's really what I do. One of the things that I believe is the best way to learn how to trade is to not think inside of the boxes that that a lot of people get trapped into. And I think the best edge is between your ears. I've said this a million times. I don't trade a systematic approach, so to speak, even though it is systematic at the end of the day. I trade a set of rules inside of my mind. And one of the most important rules is for me to get on the right side of the market as much as possible, and then the profits will take care of themselves. And I've made several videos in case any of you want to go back and review some of my videos. I highly recommend you do, because I think that's the best way to make a living as a trader, and that is to have a bunch of rules, but different rules than what you're used to. Anyways, one of the rules I have is the mindset of the business of trading. All right. This webinar will probably be a little bit more boring, very similar to my webinar on psychology, where it's going to be mostly just me talking. Maybe I'll throw up some charts, but like I talked about in my psychology webinar, the importance of this, in my opinion, is way more important than anything you're ever going to look at on charts. Okay? Please heed my words. You guys are getting 27 years of experience here. People pay me a lot of money to get this experience. So the words I'm saying to you are not just casual things. They come from a lot of blood, sweat, and tears, and a lot of frickin' gray hair. I hope I don't, like I said, I hope I don't bore you, but it's really important that you understand some of the key concepts of what it is to be a trader. A lot of people think they spend 95% of their time looking around for some mechanical way, whether that be through indicators or whether that be through some type of trigger system, or they spend 90% of their time, 95%. I'm going to go far, say 98% of their time on their charts and on their indicators and on their method. But it's funny because I am so convinced. I spoke with a guy last night from Singapore who's interested in taking my coaching. Maybe if he's in the room. I forget what his name was. Ken. Ken, if you're in the room, hi. Ken was a relatively decent trader. Makes 30% a year. And Ken called me up, and I said, okay, Ken, why don't you tell me a little bit about what you've been doing? And I was kind of impressed with Ken a little bit because Ken spent a lot of his time not necessarily looking at charts, but by looking at by handling his money management. And I said, okay, well that's great, Ken. Well, what do you use to make decisions to enter and exit the market? And Ken said, well, I studied a little bit of Toby Crable, and I studied a little bit of inside bars, and he still is a profitable trader, but not nearly as profitable as he wants to be. But what impressed me about that was that he was spending 90% of his time on money management, okay, which is an important aspect of trading because money management is kind of a shortcut to psychology, which is kind of what the topic of today's webinar is, and that is the business of trading, okay? And yeah, Toby Crable was one of the very first books that I read, Philip. I remember Toby Crable's book was selling at one point in time. Don't quote me exactly on this, but his book, Opening Range Breakouts, was selling for like $4,000 at one point in time. I think it was more than that. I think it was like the original copy was like 20,000 or something. I don't remember exactly, but it was a long, long time ago. It's been since pirated, and you can find it on the internet. But in any event, yeah. But getting back to why I believe Ken from Singapore was a profitable trader. Just by studying money management, because it covered, like I said, what I believe 95% of people should be dealing with themselves and not dealing with the charts. And I think that if you can deal with yourself and you learn to understand yourself and your strengths and weaknesses, and you build up your edges inside of your brain, then the charts will take care of themselves. Right? Charts will take care of themselves. And a big part of that is how to treat trading as a business. Right? Now, it's funny because my whole life I've always considered myself to be a businessman. Even though I've been a trader for my entire life, I've always considered myself to be a businessman. I've had forays into different business events. I was a partner in a cell phone company. I used to own a co-partner in a martial arts studio. I was also got involved with concert promotions and also did a bit of management work for some entertainment artists. And I also owned a mixed martial arts company most recently. And so most of my life, I never really considered myself to be a trader. I really considered myself to be a businessman, even though I made my living as a trader. So I guess that's what this is kind of a shortcut to psychology. In my psychology video, for those of you that missed it, I know a lot of you that were in that webinar absolutely loved it. I got tons and tons of emails and Skype messages afterwards saying that it really hit home and a lot of people really enjoyed it. But this is kind of a breakdown of it, and we're kind of getting to the nuts and bolts of what do you call it, of how to deal with the psychology. Because I think if you approach trading as a business, then it kind of shortcuts that psychology thing, okay? So what do I mean by the business of trading? All right. Well, there's a couple of things that I think that are important. Let me just see what my slides are here. Okay. So trading is a business. If you're not a professional, what are you? Okay. Now, what is the term? If you Wikipedia, Google, I think you'll find that I remember thinking, the word professional. Professional is such a misoverused word. I think that in trading, I think that word is one of the most overused and understood words in the business. So what is your definition of being a professional trader? We always hear trading with the pros, like this professional trader or that professional trader, or I want to be a professional trader. And it's really a very ambiguous word in the trading world. And the reason why it's ambiguous is because in trading is because if you're a professional athlete, you're a professional athlete because you're playing for a major league team, right? So anybody playing for college is an amateur athlete because they're not getting paid technically, but we all know they do get paid. But anyways, it's a whole other story. But a professional is somebody that makes a living from their business. All right? So a professional is somebody that makes a living from their business. But in trading, again, it becomes ambiguous because what happens if you make a living for a month? Are you a professional trader? What happens if you work on the desk of, Bank of America? Are you a professional trader and you're just order execution? Are you a professional trader? I don't think so. You're just doing order execution, right? What happens if you have a good year? Are you a professional trader? I don't know. Okay. So where I start off and my criteria is that the market moves in cycles, typically 7-year cycles in historical. So my qualification is that you can't call yourself a professional trader until one of two things. Either you're working for an existing institution where you're not just an order fill person, you're actually making decisions about market direction and market movements, or you've been trading for over 7 years and you've had at least a 7-year consistent track record of profitability. Okay? Woo. A lot of people probably freak out when I just said that, right? And the reason I say that is because I've seen so many people come and go. All right? I've seen traders that have come and work at different prop firms and things that I've worked at, places that I've worked, and friends and colleagues that have had great years. They've come in, they've made $2, $3, $4 million, and then given it all back in a couple of months. And they've had 1, 2, 3 good years, and then they have a really bad year and they blow up. Okay, so I'm going to set the bar really high, all right, when it comes to you calling yourself a professional trader. And I think it's important to do that because I think there's too many other companies out there and too many other people selling you things that make you believe that you can, go and take a course and put a little bit of money behind yourself and become a professional trader, right? And I think that's just so dangerous. And the reason I think it's dangerous is not to dissuade you from becoming traders, because I do honestly believe that every single person can become a a good trader and can make a living from trading, as long as you're not a complete idiot. But I think that the way of doing that in our industry is very misleading and dangerous. Very dangerous, because I think that it puts a false sense of expectation in people's minds. All right? But here's the good news. Even though you might not be a professional trader for the next 7 years, you can start to think like a professional. Again, you guys will find this theme through all of my videos, okay? It's not what you're doing that's important. It's how you're thinking that's important. Okay? Profits will take care of themselves if you get your thinking right, all right? So, if you're not a professional, then what are you? Okay, let me go forward here. Sorry. I don't make my own slides. My partner makes my video presentations, and I always get surprised. I don't even look at them before I just give them a brief outline of what I want to do, and I say, find pictures that kind of give you that idea. He's a funny guy. So here we have Jack Nicholson and One Flew Over the Cuckoo's Nest, which, some days I feel like I am. And, the two serious people on the other side that are professionals, right? Now, let me dispel a myth right now, right away. Let me just dispel one of the biggest myths about trading. And I've found that from my own experiences, okay? One of the things that I find is like almost universal is the state of mind that you're in, okay? Now let's talk about professionals. Okay? This is really interesting. Have you ever seen Richard Branson or Warren Buffett or Mark Cuban? Well, Mark Cuban might be a good idea. But let's just use Richard Branson and Warren Buffett as the good example. It's funny because I was watching an interview about Warren last night, and I'm a firm believer, and it's not necessarily true with everybody, but I'm a firm believer that when you are doing something very, very well, you're having a really good time. Okay? And one of the things that I find, especially with some of the people that have come to me to help them trade, I find that being overly serious in trading is a bad thing. But I want to differentiate between being serious, because I was very, very serious as a young man, and being a professional. Okay? So one of the things I want to challenge everyone, all 50 people in this room right now, to do is for the next week I want to give you a little challenge. I want you to notice when you're enjoying trading. And I want you to notice when you're not enjoying trading and you're too serious. Okay? So differentiate between being serious and being a professional. All right? Whenever I'm serious and I'm focusing on the markets and I'm not having fun and I'm not enjoying myself, I almost categorically have either a losing day or a break-even day. And so I want to challenge you guys to pay really close attention to your state of mind and your mood. Okay? And I know some traders like to put music on in the background, and I think that's a really good thing to do. They say Mozart is really phenomenal for stimulating good endorphins in your mind, and also to put you in a creative state of mind. Okay? Because a lot of discretionary trading is using intuition, right? And using intuition to make projections of where you believe the current price activity will lead to in future price activity. Okay? So it's funny that my partner put One Flew Over the Cuckoo's Nest and then these two serious people in the slide because I'm somewhere in the middle. Okay? But let's talk about the business part of it. Okay? So what's the business part of it? Now, let me see what my next slide is here. Oh, okay. So the business part of it that I consider to be the business part of it is actually threefold. Okay. Let me just answer some questions here. I see some comments here. Yeah, Fernando says something really interesting here. Fernando says that success leads to satisfaction and failure creates frustration. Right. And so I'm going to challenge you, Fernando, a little bit. Right. I'm going to say, what comes first, the chicken or the egg? Right? I'm going to challenge the whole room again. For the fun of it, you guys try this. Everybody, please try this. For the next week, when you're trading, I want you to randomly laugh 5 times during the course of the day, just for the fun of it. I've got myself to the point right now, when I have a losing trade, I break out in laughter. And I find it's really, really, really helped me a lot. Right? I break out in laughter. Like, I'll go, oh, man, and I'll laugh my head off, and I'll go, what a joke, and I get stopped out, and blah, yada, yada. If I'm laughing, I will handle the next trade much more better. Where if I'm frustrated, I will not handle the next trade much more better. So, again, let's see if we can find some shortcuts to get you thinking about this as a business, okay? Now, a lot of people say, well, this is a business. Philip writes something. Philip writes, Mozart wrote great tunes, but he wasn't very professional. Yeah, he partied a lot from what I understood, right? But anyways, how do you start thinking about this as a business? So what's the business part of this, okay? Where do you have to be dead serious? Where do you have to be absolutely like a rock, unequivocally unshakable? What's the business part of this? Well, some people say write a business plan, right? Write your trading plan out. I know a lot of the psychology books will say write your trading plan out. And I think that's good, right? I think it's important that you write your trading plan out. And, if it helps you, review it every morning. My trading plan, I'm looking at it right now, okay? My trading plan is literally on I'm not exaggerating, it's on a 5-inch by 3-inch sheet of paper, and it's got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. It's got less than 20 words to it. And I do have a trading plan, right? But it's less than 20 words, right? So what's the business part of this? Is it having a trading plan? Is it money management? Is it defining your rules and actually having them all analytically correct? No. In my opinion, no. The business part of it, where you have to be dead serious, is when it comes to stops. Okay? When it comes to stops, you have to be dead serious. Right? Absolutely, 100%, not even 99.9%. Serious about it. You cannot even remotely come close to calling yourself a professional trader unless you use stops on 100% of your trades 100% of the time. Okay, now, do I do it? No. I don't. I do have an emergency stop always. Okay, but I have earned the right to not, because I know some of you have seen my other videos, and some of you are going to say, oh, yeah, Steve's a hypocrite. I don't see stops on his charts, right? I've seen his platform. Steve doesn't use stops all the time, right? But in the first 3 years of building your knowledge and your consistency, I do use a stop, by the way. It's just always what I call a catastrophic stop. Okay. I don't like to actually use hard stops because I'm so used to getting in and out quickly that I don't really have to worry about it. Right. I've earned the right to not do it. But if you are not a profitable trader for 7 years like I am, then you have to use stops on every single trade. And yes, it means you're going to get stopped out more and you're going to have to re-enter, right? But the difference between that and not using stops is the difference between a professional at the level that most of you are at right now and a non-professional. So, members, I said that it's going to take 7 years before, in my eyes, any of you are going to be professional, but in the meantime, you can still act like a professional, and you can still act like you're running a business, okay? And so part of running our business is, the absolute critical part of running our business is the importance of using stops, okay? So once again, who in here wants to be a professional trader? All of you, right? You wouldn't be here if you didn't. You know, probably 3 or 4% of you are actually making a living, right? And the rest of you are still trying to find your path, right? And the most important step in finding your path is treating it like a business. And no businessman in the world would open let's say you open up a restaurant, right? And all the money in the world that you have is $1 million, right? That's all the money in the world that you have, right? You have nothing else but this $1 million, right? And you open up the restaurant, it costs you $500,000 to open up the restaurant, and 6 months into it, you're still bleeding $100,000 a month, and you're at the end of your rope. The restaurant's losing $100,000 a month. Do you pack it in, or do you go and borrow money from your friends and relatives? Right? Well, you might say, well, I'll try another $500,000, right? And now you've lost all the money you had, and now you're $500,000 in debt. Would you now go and borrow another $500,000? No, of course you wouldn't, right? Well, this business, we don't have a restaurant. We don't have hard assets. We don't have anything. What we do have is our capital, right? So I know you guys have heard this all 1 billion times before, and I know I'm probably not telling anybody anything new here, right? But hopefully I can tell it to you in a way that will maybe help it make a little bit more sense to you, okay? So if you want to call yourself a professional trader, then you have to use stops 100% of the time, okay? Now, if all of you go and do that for the next 5 years while you're still trying to become consistent, then I think you have the right to call yourself a professional, and I think you're treating this business as a business, okay? Yada, yada, yada. Some of you are getting bored. I don't care for those of you who are getting bored. If I help one of you understand the importance of this and give you then I'll have done my job. The next thing, and again, this has been beaten to death, the importance of using risk-to-return ratios. Okay? The importance of using risk-to-return ratios. Now, this is, again, another all another very, very misunderstood thing. Okay? I don't look at the risk-return ratios the way most other people do it. I look at it as, am I being a businessman? Because no businessman buys a shirt from China for $1 and sells it in the United States for 50 cents and survives very long. Yes, I know, Mike. It's a lovely curve, isn't it? Okay. So I don't care what your style of trading is. Okay. Philip asked me, is it okay for scalpy trades? Right. I don't really have an answer for that specifically, Philip, because there's some other math that goes that, right? There's some other math that goes with that. All right. So the math that goes with that is that if your winning trades are 50% winners and 50% losers, then I think you need to have at least a minimum of 2-to-1 to have long-term profitability, right? If your winning trades are 60% winners and 40% losing trades, then I think you can get away with some different math. And, in my case, my winning trades are much, much higher. I won't get into actual numbers because you guys will think I'm full of shit, full of poo. But my winning trades are pretty high. So my math doesn't always have to be 2-to-1. All right. So I think it's a whole topic in itself that, I could probably spend an hour and a half on just that topic. But the point that I'm trying to make is that you have to understand the math of your business. And here again, herein comes another dichotomy or another paradox of our business, because what's a large enough sample size? Now let me tell you what I'm talking about. For any poker players, they work on some really interesting things. They say that they don't have an edge until they reach, I believe it's 150,000 hands of poker. Now, for those of you that don't know 150,000 hands of poker, depending on if you were to play 150,000 hands of live poker, it would take you, let me just check something here. It would take you, it's an average of 20 hands, about 200. If you played for 10 hours of poker, you see about 200 hands live. Okay? So if you see 200 hands live in poker, it would probably take you about 2 or 3 years to see 150,000 hands of poker. So in order for someone to have an edge in the poker world, they say you don't have the proper math and the proper edge until you've played 150,000 hands. Now, on online poker, you can play 5 and 6 hands at a time, and it's much faster than live poker. But in trading, it's the same type of problem. The problem with trading is that, and again, this is one of the misleading things that people want to make you to believe, is that your sample size in trading has to be large enough to know if you have the right edge, right? So one of the shortcuts that you can use, because you're not going to get 150 trades in, 150,000 trades in. I'm not suggesting it takes that long at trading. I think in trading the math, I think if you do 5,000 trades and you're net profitable after 5,000 trades, I think that you've got an edge, right? 5,000 is a lot of trades, right? Actually, I'd probably even bring that down. I'd say close to 2,500. I think if you do 2,500 trades, I think, and you're profitable of those 2,500 trades, I think that you have a mathematical statistical edge. But I still think that you don't really know if you're going to have an edge until you hit 2,500 trades of whatever it is that you're doing or however it is that you're doing. So scalping. So what's one of the shortcuts we can use in between now and, those 2,500 trades? Well, one of the shortcuts is to only take trades that you believe have a 2-to-1 risk-to-return ratio. All right? And I know it's, again, touted out there, but I don't think people really understand why it's touted as something that's an important thing to do. And so hopefully I've explained why it's really important to to have those risk-return ratios. So my idea of a professional trader at the level that most unprofitable traders are at are really three things. It's using stops and the importance of 2-to-1 risk-to-return ratios. Okay? So those are my two criteria for becoming a professional trader in the meantime while you're trying to get to your 7-year mark of profitability. I think if you just do those two things in the meantime, I think that you can behave like you can treat this as a business, and you can build up enough history to be able to build an equity curve like that. Because, by the way, you see this equity curve? I don't know where this came from, but it's really funny. There's in the poker world, there are what's called supernovas, and that's a guy that plays 1 million hands of poker in a year. And there's a guy called Nananuku, whose name is I can't think of his first name. Lou. I can't think of his first name right now, but I know his poker name, Nanaluku. His equity curve looks just like this. But if you were to, and it's over 1 million hands a year, right? And the reason why equity curves look like this is because of large enough sample sizes, right? So, yeah, I think that pretty much sums up everything that I want to talk about. I'm going to open it up to right now. Any questions? I'll go over some of the things we have right now. I got about 5 minutes left, and I want to just field some questions here. Let's see what we have here. Are there any other questions here? No, it's Randy Liu. Randy Liu is his name. Nananuku. You can look it up. I believe it's pronounced Nananuku. Put in Nananuku, something like that, poker player. Yeah, it's Randy Liu. And if you look up his equity curve, it looks just like that. It's just incredible. But so let's see. Asmin has a question here. How long should you be in a trade? If trading the 15-minute chart, does it matter if you're winning or losing? 1-to-1 or less. Okay. Listen, if trading was a perfect world, you'd get 2-to-1 every single time. It just doesn't happen like that, okay? You start off with hoping that you're going to get 2-to-1 on your trade. So my criteria is not always get 2-to-1, okay? My criteria is don't take a trade until you've got 2-to-1. Because I figure most traders, even if they flip a coin, can be profitable if they have a 2-to-1 risk-to-return ratio. Okay, so I figure, but you're not always going to get 2-to-1. So, for example, there was a trade today. I guess I can show the trade. Okay, let me just get some charts up here. Oh, look at that market go! Yay! Sometimes I do these things. Okay, there's a trade today that one of my students take. Can everybody see my Aussie dollar chart here? Oh, wow! I cannot believe the Aussie's getting hit like that. Okay, so here's an example. This was a trade that one of my students took today, okay? It's a 5-minute Aussie chart, and we were looking to buy the Aussie today was the strongest of the pair. Well, actually, the pound was the strongest of the pairs. I actually was looking to short the euro. I took a short on the euro here. I actually got out of my euro short, but I do believe the euro. By the way, I think the euro is going to make a new low down here, probably. But anyways, he was looking to buy the Aussie, and so when I have clients, I let them do their thing, and then I talk about it later. And Nils, if you're in the room, hey buddy, this is a true example. So there was a bit of a liquidity run here on the Aussie, where the market moved down, and then regular supply and demand came back in, and the Aussie came back up. Now, at the time, I didn't see this. Let me just talk about this. At the time, I didn't see. Oops, a sec. I didn't see this. All I saw was this, right? And I saw that the Aussie was having a hard time breaking through this level here, and it looked like there was selling pressure on the Aussie. And even though it was a strong chart, I didn't want to sell it because I wanted to sell the euro. But my client came in, and we were talking, and he said, "Okay, well, I'm gonna take this long." And I said, "Well, you're not doing anything wrong by taking that long, right?" He said, "Okay, well, I'm going to buy here." And I said, "Okay, fine." I didn't say anything, right? But I quickly did the math in my head, and I said to myself, "Okay, well, where am I going to start taking some heat on this trade if I take this long? Where am I going to start taking some heat on it, right?" And so I did the math real quickly, and I said, "Okay, well, I know that whatever is happening is probably more likely to continue to happen." And I had, I outlined some areas that I thought we were going to take some heat on this, and where there was some liquidity. And I said, "Okay, well, the trade can work, and the trade, if it does work, how's it going to work?" So I did some quick math, and I said, "Okay, well, if I take this trade here with slippage, I'm probably going to have to risk around 7 or 8 pips on this trade. And where am I going to take heat? Right? Where am I going to start having problems on this trade? Well, I'm going to start having problems on this descending level here, because there's obviously sellers that are coming into the market as the market has been trying to move up. The sellers are stepping in. So I didn't take the trade because the risk was 1-to-1. Now, he was looking at, maybe getting some liquidity up at these highs, right? And that would have made more sense, because now, you got about 15 pips to the next liquidity level if the market continues to stay strong during the New York session, like it did during the, Asian and London session. So I didn't take the trade because I didn't like the return on it, but I did like the possibility of doing a liquidity run down into this area. But I didn't want to short this, right? I wanted to short the euro, but just to give you some idea. So anyways, he took the trade, and sure enough, the trade went up, and he ended up at this level up here, I believe it was. He ended up, when we took out this level right here, he ended up taking off half of his order and moving it to break even. I said, you can do two things. You can take off half there and move your stop to break even. You can hold for your target and can maybe get 2-to-1, which is good thinking. Like, I understood his logic behind it, right? But I just didn't like the selling pressure that was coming into the market. Or you can just move your stop. You can not take your profit here, and you can just move your stop to break even, and in the worst case scenario, you're going to get stopped out. Well, he opted for number 2, right, to take off half of his profit and to move his stop to break even. Excuse me. Apologize. I ended up expecting the Aussie to come down to this liquidity. And Nils, if you're in the room, you can verify this is 100% true. Nils, if you're here, if you're not, that's okay. So anyways, the market ended up coming down, grabbing this liquidity like I thought it was because there was too much selling pressure. I ended up shorting the euro. And so my point that I'm showing you this trade is not to show you guys anything else other than the fact that, other than the fact that his trade at this level was okay. Oh, hey, there's Nils. Hey, buddy. It's 100% true, isn't it, Nils? His trade at this level was okay. It was a good trade, and so, I said, you're doing nothing wrong by taking this trade here at all. And then I pointed it out to him. I said, after he took the trade, I mentioned to him, well, look, where are you going to take heat on this trade? Where has selling pressure been stepping in? Right, exactly. Right, and so I knew that at the first level that he was going to take heat on this trade, that the selling pressure was going to step in for sure. I mean, there's no reason why sellers would not show up here again, right? And there was a slight liquidity run to the upside, but his trade was good, right? His trade was a good trade. Now, the reason I share that with you today is because not all trades are going to work out where you're going to get your 2-to-1, and you should either just hold for your 2-to-1 profit or break or get stopped out. It wasn't required in this particular context, right? In this context, if he was taking heat at this level, then there's no reason why what was happening wasn't going to continue to happen, and why take a full loss on this trade, right? So he opted to take half of the trade off here with some profit at 1-to-1, and then he ended up moving a stop to break even on the rest. So I point that out to you because it's important to start off with a 2-to-1 risk to return, but it's not always important to get it. Okay? It's not always important to get it. But every trade should have a stop, and every trade should have the potential target of a minimum of 2-to-1, and now you're treating it as a business. Make sense? Okay, so once again, my name is Steve Patterson. My information is down here. You can email me. You can Skype me. You can even call me. Feel free to ask me any questions on Skype or email. Some will tell you that I actually do get back to people. Okay, if that's it, and there's no other questions, I've already gone a few minutes past my time, and hopefully everybody enjoyed it and got a little bit out of it. Bye for now.